What is a debit? What is a credit? Who gets what and why? Today, we're diving into the often mystifying realm of debits and credits in a real estate closing. My name is Maggie Relloso, and I'm with Just Call Maggie, and I help people like you pass the real estate exam. So, by the end of this video, I hope that you'll gain the confidence to understand who gets what and why in a real estate transaction, and that you'll be able to solve those questions on your exam like a pro. Let's get started. All right, let's start with the basics. What is a debit and what is a credit? In a real estate closing, debits and credits are like the yin and yang. They balance the financial scales to ensure a fair exchange for both parties involved. Debits represent money owed or expenses, while credits are the opposite, representing money coming in or reductions on what is owed. Think of it like when you use your debit card, your bank account will show a minus sign or a deduction of funds when you use it. And should you return an item that you've purchased, you would be getting a credit or a plus sign or money added to your account. That's exactly how I made sense of all this information for my exam. And I hope that helps clear that up for you because we're going to break it down even further. Now I'm going to give you a set of rules to help you ace these types of questions on your exam. The majority of times your answer on the real estate exam will be debit to seller, credit to buyer, and the exact amount to each. But like always, there are some exceptions to this rule. For example, for prepaid items, which are payments made in advance in full by the seller, like a monthly HOA payment or a tax payment for the property for the year, they will show up on the closing disclosure as a credit to the seller and a debit to the buyer, since the seller has already paid the balance in full. So the seller will be getting a credit. Next, the purchase price will also show up as a credit to the seller and a debit to the buyer. Here's a very common question seen on the real estate exam. How is the purchase price entered on the closing disclosure? Is it A, a credit to the seller only, B, a debit to the seller only, C, debit to seller, credit to buyer, or D, credit to seller, debit to buyer? The answer is D. Credit to seller, debit to buyer. The seller receives the purchase price money while the buyer pays the purchase price. So the buyer is charged or debited the purchase price and the seller is credited the purchase price. Here are some other ways debits and credits show up on the closing disclosure. The loan amount and earnest money deposits are shown as a credit to the buyer only. So in conclusion, if the seller has not prepaid anything and they're not asking about the purchase price, the loan amount, or the earnest money deposit, your answer will be a debit to the seller and a credit to the buyer for the exact amount to each. Okay, now that we got those rules down, let's discuss proration. Let's jump into 3 sample questions where we prorate a rent payment or a monthly amount. The second one will be a proration of annual property taxes. And the third one will be an amount that was prepaid by the seller. This way, you're prepared for whichever type of proration question that may appear on your exam. Number 1, a tenant paid their monthly rent on the first of the month in the amount of $1,300. If closing day belongs to the seller and is set for April 9, using a 365-day calendar, how will the rent payment be prorated on the closing disclosure? Feel free to pause the video now if you'd like to work out the problem on your own. Okay, so when it comes to prorating a monthly rent payment, imagine you are buying a property that has a tenant already living there who has paid their rent for the month. The problem is that the tenant paid the seller their rent. So it's not fair for the seller to keep that entire month's rent to themselves if you are going to be the new owner for a portion of that month. So the seller owes you, the buyer, a credit for the portion of the rent for the time you, the buyer, owns the property. As you can see, it's all about fairness and ensuring each party pays or receives what's rightfully theirs. So let's work this one out. Remember that these amounts must be the same, so we can automatically clear out answer C and D since those totals do not equal. Since we're only talking about a month's rent payment, we are not concerned about the months January through April. So we will just use the number of days in that closing month. Remember, if we are to use a 365-day calendar, we use the number of days each month has. And 360-day method, we use 30 days for each month. Since this question specifically mentions a 365-day calendar, we'll use the number of days in the month of April, which is 30. So we'll take the amount of money in rent, which is $1,300, and divide it by 30. That equals 43.33333. Now, closing date is April 9, and it belongs to the seller. So we include that day, which gives the seller only ownership of that property for 9 days. Now we just multiply 43.3333 times 9, which equals 389.999. Since we have a 9 as our last digit, we can round up to $390. That's how much the seller will keep. Now to see how much the seller has to cough up or credit to the buyer, we just subtract $1,300 minus $390, and that equals $910. So the answer is B. Credit to the buyer, $910. Debit to the seller, $910. An easy way to learn these steps and solve rent proration questions like a champ is the DAMS method. DAMS stands for the 4 steps we just took to solve that last equation. The 4 steps are divide, add, multiply, and subtract. Let's try another one, but this time we'll be using the DAM method. It's the same thing, just one less step. And this time we'll be prorating an annual property tax. A good way to remember which one to use is that DAM has 3 letters, just like the word tax, and DAMS has 4 letters, just like the word rent. So use DAM for annual tax prorations and DAMS for monthly rent proration questions. Easy enough? Let's check out this practice question. Number 2. The annual property taxes for a property are $2,340. If closing is set for June 7 and the buyer has agreed to be responsible for the day of closing, how will this be reflected on the closing disclosure? Feel free to pause the video now if you'd like to work out the problem on your own. Okay, let's talk about annual tax prorations. In this problem, we'll be using the 365-day method, even though it has not been explicitly stated. Say you're closing on a property mid-year and property taxes are paid annually in arrears. Paying in arrears pretty much means you pay for an item or service after you've received it. For example, in Florida, we receive our property tax bill in November for that entire year. So you live in your property all year long and pay taxes on it at the end of the year. Now, when using the 365-day method, we have to calculate the daily tax amount. See how many days the seller lives in the property and debit the seller for that portion of the year they owned the property. So let's use the DAM method to work this one out. Let's get the total amount due in rent, which is $2,340, and divide it by 365. That gives us 6.41095 per day. Now we add up all of those days from January 1st all the way to June 6th, since the buyer owns the day of closing. We get a total of 157 days. And the last step is just to multiply. So 6.41095 times 157 days equals 1,006.519, which rounds up to $1,006.52. So the answer is B, credit to buyer and debit to seller for the same amount of $1,006.52. All right, now we're going to solve a proration question where the seller has prepaid an amount already. Let's check it out. Number 3, James is buying Arthur's house. Arthur has already paid the annual HOA dues in the amount of $763. If the closing date belongs to James and is set for May 13, how will this appear on the closing disclosure? Use a 360-day calendar. Feel free to pause the video now if you'd like to work out the problem on your own. Homeowner association fees are a common proration seen in real estate closings. By using the 360-day method, we use 30 days for each month, even February. We calculate the daily HOA fee and adjust credits accordingly to ensure each party pays their share based on the portion of the year they've owned the property. Remember, the seller has already paid the HOA balance, so he will be receiving a credit now for the portion of time he did not live in the property. For prepaid amounts, we use the DAMS method, just like we did for rent proration in our first example. So let's break it down. First, we divide. We get $763 and divide it by 360, which is going to equal 2.11944. Next, we add up the total amount of days the seller owns the property, which is from January 1st to May 12th. That equals 132 days. Now we multiply 2.11944 times 132, which equals 279.766. And we could round it up to 279.77. Lastly, we subtract to find how much the seller gets back. So $763 minus $279.77, and that equals $483.23, which is what the seller will get a credit for. So the answer is A, debit to buyer, $483.23, credit to seller, $483.23. And there you have it. Debits and credits in a real estate closing demystified. Understanding these concepts is crucial for acing your real estate exams and navigating the world of real estate transactions with confidence. Need more proration help? Check out my video right here for more proration practice. If you found this video helpful, don't forget to smash that like button, hit subscribe, and drop a comment below with any questions or topics you'd like for us to cover in future videos. Remember, knowledge is power in the real estate game. So keep learning, keep hustling, and I'll see you in the next video.